progress at the end of yesterday. Then you finish whatever you started today, except for the portion, the little bit of what you might have started and worked on today that will be in work in process at the end of today, which will be finished tomorrow. And so the answer to the question, how much do you finish today or each day, that is actually the purpose of equation 3, that is the cost of goods manufactured. Okay, what's a direct material? That is the purpose of equation 1. In our example, it would be the raw clay that you can directly see. You know, the raw clay itself is the direct material that becomes the clay pot. What's an example of overhead, which is the OH in equation 2? Well, it's not raw clay that is the direct material, or DM. It's not the person who physically sits there and shapes the clay with his or her hands. That would be DL, or direct labor, in equation 2. It wouldn't be any kind of sales or administrative or other general expenses. That would be the GA in equation 5. The cost of overhead is any additional costs that are used to produce the product, or as we say in equation 2, it's the overhead, or OH, that is actually used in production other than the direct material, other than the direct labor. And since you actually use the grease that lubricates the spindle as something that you need for production, that would be an example of overhead. So the answer to that question is the final choice, the grease that lubricates the spindle. Okay, next to last question is another equation 3 question. If you look at that equation, because you have two different numbers, minus work in process at end of day equals cost of goods manufactured. If the number work in process at end of day gets bigger, the number cost of goods manufactured gets smaller. And you can see that just by the structure of the equation. On the left-hand side, we're subtracting work in process and end of day to calculate cost of goods manufactured. If the thing that you are subtracting gets bigger, then the thing that you are calculating in equation 3 gets smaller. And that's why the answer will be smaller. Now, for the final question, anything that represents a legitimate business expense, but that is unrelated, it is not related to actually producing your product, is a GA, general and administrative expense, way down in equation 5. And some of the examples that I gave a couple days ago were, it could be a sales commission paid to a salesperson who never steps foot in your factory. Well, that's one example given in my question. There's the accountant who works in his or her office to prepare your tax return. Again, maybe never ever steps foot in your factory. I mentioned that in the question. And I think the third example I gave you a couple days ago is, if you want to plant some grass or some shrubs or some flowers in front of the building to pretty it up a little bit, you can do that. It is a legitimate business expense, but it is unrelated to producing the product. And therefore, those costs do not appear in equations 1 through 4. They are not included in cost of goods sold, but they are legitimate business expenses that reduce your earnings. And as a result, they are in GA for equation 5. Now, if you say, okay, so let's look at equation 5. The logic for equation 5 and this question is similar to the logic of equation 4 in the last question. Equation 5 says revenue minus cost of goods sold expense minus GA, general and administrative expenses, equals net earnings or net income. Okay, once again, we are subtracting these expenses to compute earnings. If these expenses are larger than expected, then earnings will be smaller than expected, given the structure of the equation. Okay, so let me pause. Those are my explanations. Questions? Dawn, go right ahead. Okay, Dawn, I think you are muted.
Okay, sorry, I had to figure out how to unmute. So
No.
I have a question, and I've always understood overhead to be expenses that do not have anything to do with the production of the product. So where is the shift? Am I understanding that differently? Is it a different concept, or because I chose the advertising expenses overhead? So what makes it what's the difference?
Right.
Where does it shift at?
I'm afraid that your understanding, but what you just described, is not correct. The difference between overhead and general and administrative expenses is that overhead costs are indeed used in production, whereas general and administrative costs are not. And in fact, if you look at the 5 equations, if you
No,
were
I see it here. I'm just saying, was there a shift in terminology at some point? I haven't taken an accounting class in a while.
No,
No.
I actually, you may be, and please forgive me for saying this, but you may be remembering, you know, the original concept as it was taught to you incorrectly, or maybe it was communicated incorrectly. But these equations, although many things in accounting that never ever change, you know, debits and credits, that kind of thing. There are many things that do change. This is something that has never changed. Overhead has always been understood to mean it is the costs. And if you look at equation 2, equation 2 is called the numbers that go into total manufacturing costs, because those 3 items, including overhead, are costs used in production or manufacturing the product.
Okay, thank you.
Sure. Okay, other questions? And going once. And going twice. Okay, let me make Dawn, let me mention one more thing, and then we'll wrap up the quiz and jump into the material. The whole point of equations 1 through 4 is to help you get to equation 5. And the whole point of equation 5 being structured as it is structured is that cost of goods sold in equation 5 are all the costs of production, whereas general and administrative expenses in equation 5 are all of the other non-production costs. Now, why should you care? Well, let's assume for the moment revenue is 5 and cost of goods sold is 4 and general and administrative expenses are 2. Now you might say, oh no, 5 minus 4 minus 2 is -1, we're losing money. Well, usually what an accountant would do is say, okay, 5 minus 4 minus 2, we're losing money. Is revenue minus cost of goods sold, I mean, forget about GA. Is revenue minus cost of goods sold a positive number? Yes. Revenue minus cost of goods sold, 5 minus 4, is +1. Well, an accountant will breathe a sigh of relief and say, well, at least the money that we're getting from selling each product is more than enough to cover the cost of producing it. So if we could just figure out a way to take those non-production costs and reduce them, we'll make money on each item sold. On the other hand, let's say you have a loss of $1, earnings of -1. If it's a situation where revenue is 5, cost of goods sold is 5.5, and GA is 0.5, well, you would say 5 minus 5.5 minus 0.5, uh-oh, that's -1. Well, then if you say, okay, but is revenue minus cost of goods sold positive? No, 5 minus 5.5 is -0.5. Oh no, says the accountant, that's extra worrisome because that means that you're losing money on your sales price. I mean, you're doing so poorly that when you produce and sell something, the revenue that you get for selling it doesn't even cover the cost of producing it, even before those other expenses. And so the big question, does the revenue that you are getting from selling a product at least cover the cost of producing the product? It's sort of the least that you can ask for before you get really, really, really worried. That's the key question that this entire set of equations is focused on answering. Well, if that's the case, then cost of goods sold really does have to cover or include all of the costs of production, but not the non-production costs, which is why the cost of an item used in production needs to be in equation 2. And in this case, the cost of the tube of grease is an overhead, whereas all of the costs that have nothing to do with production, such as sales expenses or accounting expenses, cannot be an overhead, or else they would make their way down to cost of goods sold. And you don't want the non-production expenses to be in cost of goods sold. You want them to be in general and administrative. And so that's why it's always been the case that production expenses are always in equation 2. And as you can see, they sort of flow their way down to cost of goods sold in equation 5 if they're not direct material and if they're not direct labor, but they are items used in production, they would be overhead. Okay, let me pause. Questions about what I just said? It is important because it's the reason why we're doing this to begin with. Yajara, go right ahead.
Professor, so the advertising campaign would be considered what?
GA in
So,
equation 5, general and administrative expenses. It because the money that you spend on advertising has nothing to do with the cost of manufacturing the product.
okay, so like if in another scenario, an example, like in a tax office, like the ink or like the equipment for the printers, that would be considered.
Yep, that would also. So sometimes it's a little difficult or it's a little tricky to classify it. If you have a printer in the office of your accountant, and if the accountant is, I presume, nowhere near the factory floor, then the cost of that printer would be GA, general and administrative expenses. On the other hand, if you've got a printer sitting on the factory floor and the factory floor manager is using it to print out instructions and then is running around and handing the pieces of paper with manufacturing instructions to people on the assembly line, then the cost of that printer would be overhead.
I see. Okay. Thank you, Professor.
Sure, sure. Other questions about that? Okay, so that concludes our discussion of this content. I'm going to close.
Can you repeat that example, please?
Sure. So if I have a printer and I'm an accountant and I'm just filling out tax returns, I'm not producing anything. In fact, as an accountant, I may not even be sure what is being produced and how. I'm filling out tax returns. I might have a printer on my desk. The cost of the printer and the paper that my stuff is printed on, and the toner, the ink, all that would be general and administrative expenses in equation 5. On the other hand, if the manager who is on the factory floor, who is managing the factory production process, if he says, I need a printer because from time to time I will print out instructions and then run around the factory floor and hand the paper instructions to the people who are on the assembly line actually producing the product, then that printer and the cost of the paper and the cost of the toner or the ink, that's all being used as part of the manufacturing or production process. And as a result, the cost of that printer would be overhead. The difference is that in equation 2, if you look at equation 2, overhead represents items that are used in production. Any other questions? Dawn, go ahead.
Okay, I'm not arguing with you at all. I just want to know because it's important to me because these terms, like they have specific meanings. So I just sat here and casually Googled overhead expense, right?
Mhm.
And generally, in every definition, it says that overhead expense is not related to the actual production of the product in every definition that I've read, right? And like I went to Forbes, Investopedia, I went to Texas CPA, but I couldn't find the exact wording and there's too many words. So I'm just trying to figure out because as I go on about this is literally my career. So as I go about doing, I want to make sure that I am saying these things correctly, right? So I'm not worried, but I'm wondering what is the difference of it being used here in this way and everywhere else in another way. Well, not everywhere else, but in other places another way. What is the defining guideline, I guess, that separates when it is considered part of production and when it is not?
Okay. What I don't want to do is ask you to show me, or have
Oh, I have them saved. I'm going to email them to you because I'm going to ask you later. I really want to answer to this question. So even if we're not able to get to the end of it here, I'm going to bug you about it later anyway. So if you want to move on, we can do that. But if I'm thinking if you have a definitive answer, right, then I'm off.
Right. So let me give you a general answer. When you get into advanced applications, and this is an intermediate class, we're not in an advanced class, then the word production and actually the word inventory is used in unusual and flexible ways. And I'll just
Overhead used in production is the defining term.
let me complete my thought. For instance, let's say I'm a talent agent. Maybe I am representing fashion models. Maybe I'm representing players that want to be signed for a sports team. And so I'm a talent agent of one kind or another. The people that I am representing are clearly human beings. And so you would think in this type of advanced application, I would think of them as laborers or DL, direct labor.
Mhm.
However, in that application, the talent agent often will refer to the people that he is representing as inventory. Okay, and he will go into a sports team or go into a fashion house and say, you might want to buy one of the people that I am representing. Let me show you my portfolio of inventory because each of these people, or human beings, are inventory items. In addition, you know, he or she, the agent might say, when I go and find someone who is literally, sitting in the street, well, I don't mean in the gutter per se, but, maybe I found them in a coffee bar. I look at them and I might say, or maybe I'm going to a public park and I see someone playing baseball or soccer, and I say, that person is someone that I can represent, but boy, are they rough around the edges. I'm going to have to work with them to polish them up in some way before I can sell them. Well, they might refer to those unpolished, rough around the edges people as direct material. And then as they start to work with them and polish them, get them ready so they can be sold, they become work in process. And at the end of the day, when he says, okay, you're polished up now, I can now put you in my portfolio of inventory and offer you to people who want to buy you, then they become finished goods. I'll give you one more example, and just briefly to show you how in advanced contexts, the definitions get fuzzy. Students in a university, you might say, well, those are the university's customers, and they are purchasing the goods, the finished goods that are ready to be bought. Well, that's one way to think of students, but there's another way to think of students, which is to say, no, students are not the customers who are buying education services. Students are the product, the finished goods. And the whole point of having a career fair, the career fairs that we stage, is that the customers who are your potential employers are coming, the potential employers are coming to see the product that we are selling to them, which are the students. And the students are not the customers buying the finished goods. Students are the finished goods. And so these are all the advanced applications where these terms, they're just used differently. They're used more flexibly. But the fundamental, or for purposes of this class, the intermediate definitions, the classic definitions, overhead represents items used in production. If that wasn't the case, then equation 2 would be incorrect. Overhead would not be part of total manufacturing costs, but overhead is part of total manufacturing costs because overhead is used in production. Okay, so what I believe you're doing is you're Googling around and you're finding professional applications.
Well, that's not true. I remember I've taken other accounting classes, so I've always known it to be in my head as I was doing the test. I was like, okay, I know overhead is pulled away from. That's why I didn't choose the grease one because I know overhead is something that's pulled away from. but I do understand what you're saying. So in this context, it is maybe it's the manufacturing piece of it, but in this case, it is overhead is used in production. So that's cool.
Okay. And by the way, I'm more than happy to continue the discussion after class.
Thank
I,
you.
I would simply say to everyone, when you're Googling around to Forbes, you know, or other sites on the internet, number one, the sites may not be reliable. Number two, even when they are reliable in general, they might be referring to a certain level of knowledge and education or a certain industry application that is different than the universal or generic intermediate level education that we're covering right now. Okay. So with that, let me close that. Let me open our list. Now, what I've done here, and remember, by the end of today, I will highlight in yellow the items that we covered today that will be on our next quiz. Oh, and by the way, remember, Thursday next week, we do not meet, okay? We will not meet on Thursday next week, but we will meet on Tuesday. And so whatever we cover today, which I will highlight in yellow, will be on Tuesday's quiz, our next quiz. Okay. So we'll most certainly cover illustration 8.2, 8.3, and the periodic information on illustration 8.6. We might have time to go ahead and start to cover 8.7 and beyond. If we do, then I will highlight them in yellow and they will be on the next quiz. But we'll see how far we go. Okay, so let me now open the textbook. We are in types of inventory. The first thing I highlighted, illustration 8-2. 8-2 is essentially, well, it's actually what we've been talking about, direct materials, which the textbook author calls raw materials, and direct labor, which the textbook author calls direct labor, and overhead, which is, as we've been talking, other costs of production, which the textbook author, consistently with what I just said, calls manufacturing overhead. Okay, the cost of your raw clay, direct materials, plus the direct labor cost of the person working the spindle, plus the cost of overhead, which are all other manufacturing costs. The sum of those three numbers is totaled in what we just referred to as equation 2. They move into work in process in what we just thought of as equation 3. They then move into the finished goods equation when you finish producing the goods in equation 4. And at the end of equation 4, you calculate the cost of goods sold, which is carried into equation 5. By the way, if you look at illustration 8-2, there is no non-manufacturing overhead. There is only manufacturing overhead, because overhead, by definition, at this level of accounting, as we are teaching you this, overhead only refers to manufacturing costs. Okay, so that's 8.2. We go to 8.3. 8.3, which is called a perpetual inventory system, is inventory the way that you've learned it. And so if you buy $600 worth of inventory because you wish to resell it, well, you've purchased the asset for resale to increase the asset inventory by 600. If you are paying cash for the asset, you would then reduce or credit cash by 600. In this example, you're not paying cash for the inventory. You are telling the vendor, I will pay you the 600 in the near future. And so you will increase or credit payable, a liability, by 600. Is there any revenue or expense at the moment that you buy the inventory? No, because if you increase an asset and increase a liability by the same amount, then assets minus liabilities equals 0. There's 0 change in the value of the company, and thus there is 0 revenue or expense. So what happens when you sell the inventory? Well, remember, when you buy inventory, there is one transaction. But when you sell inventory, there are 2 transactions. Number 1, the customer walks away with your inventory. They have purchased it. And so you're reducing the asset called inventory. It appears here that you are selling most of your inventory, but not quite all of it. And so if the customer buys $540,000 worth of your total inventory, then you reduce the asset called inventory by 540. Okay. For this particular transaction, just this one transaction, not both, just the one. If an asset goes down and if a liability does not change, then assets minus liabilities equals the value of the company. Well, if an asset goes down by 540, then the value of the company has gone down by 540. That is cost of goods sold expense of 540. Furthermore, there actually is a second transaction. You're not just letting someone walk out the door with your inventory. You're saying you're going to have to agree to pay me for that, right? Oh yeah, no problem. Give me the invoice. I will pay you within 30 days. Okay, so you hand the customer an invoice for $820. Well, you now have a receivable, which is an asset. You can expect the customer to pay you $820. Well, for this second transaction, which is happening at the same time as the first, but is distinct from the first, if an asset goes up by $820, and in this particular transaction, no liability is changing, then assets minus liabilities or value goes up by 820. And when the value of the company goes up by 820, we call that revenue. And the first thing you look at when you book these entries is this. You say, okay, what am I getting from the customer to sell them a product? 820. What was the total cost of manufacturing the product, which is the direct material, a manufacturing cost, and direct labor, a manufacturing cost, and overhead a manufacturing cost? Well, the total cost of manufacturing what I just sold is, thank goodness, less than 820. It's only 540. Okay, phew. That means that when we sell a product, what we get from the customer exceeds the cost of producing the product to begin with, which means that if we're losing money overall, it's not because we're losing money on the cost of each product sold. It must be we're losing money because we're paying the salesperson or the accountant or the lawnmower person too much. Okay, that's the very purpose of doing the accounting this way. You are comparing the 820, the money you get from the customer when you sell the customer the product, to 540, the cost of manufacturing the product. If that first number exceeds the second, even if you're losing money overall, it's because your, what I called, sales and general and administrative expenses may be out of control. But at least it's not that the money that you are getting from the customer is failing to even cover the cost of producing the product to begin with. Okay, so there's a logic to this, and there's a purpose of taking all of the costs of producing the product and combining them into cost of goods sold, and then excluding from cost of goods sold the costs that have nothing to do with producing the product. Okay, so that's illustration 8-3. Now let's go on to illustration 8-6. And the textbook author, once again, as the textbook author is wont to do, makes this probably more complicated than it needs to be. Because the textbook author says, for 8.6, we have two systems. We have a perpetual system, which we just talked through. And then he says we have a periodic system. Okay, what's the difference? Well, when you go from left to right, and again, the left column is just what we talked through. The right column is what the textbook author presents as an alternative system. For the most part, there are simply terminology differences. Now, what do I mean by that? Okay, you're buying inventory for the first time and you intend to resell it, and the vendor is charging you $620 for the inventory. When you buy it, increase the asset inventory by $620. Increase the payable, because you intend to pay for it, $620. If you look at the right column, the credit, or the increase to payable, is exactly the same. The number in the debit, 620, is exactly the same, but the debit does not say, I am debiting an account called inventory. The debit says, I am debiting an account called purchases. Well, what are you purchasing? Inventory. Okay, so this account right here in the periodic system, purchases, is purchases of inventory. It is an asset. It's just like the debit to inventory in the perpetual system. It's just a different word. Similarly, let's say you buy inventory for $620 and UPS delivers it to you. And then let's say 1 week later, you get another invoice in the mail, and it's from UPS. And UPS says, by the way, I need to charge you 16 bucks for delivering the inventory to you. Okay, I'm going to pay you the 16 bucks I owe you. Reduce cash by 16. What do I debit? Well, there's a principle here, and I hope it makes sense to you. If someone says, I'm going to sell you inventory, and to buy and receive the inventory, you're not going to have to just pay 620. You're going to have to pay 620 plus 16. If you don't pay the extra 16, you're not getting the inventory. Well then, what is the cost of the inventory? It's actually 620 plus 16. It's true that you're paying 620 to the vendor and you're paying 16 to UPS. But if you're in a situation where if you don't pay UPS the 16, you're not getting the inventory, then you're really paying a total of 636 for the inventory. And as a result, when you pay the extra 16, you slap your forehead and say, oh, that's right. The inventory that I bought, the value of that actually is 636. And thus, instead of perhaps debiting expense by 16, you add the additional cost of inventory, the additional 16, whoops, to the 620. That's why you're debiting inventory. Okay, so let me pause for a moment. Any questions about that? Imran, go right ahead.
So freighting is basically your like shipping costs, correct?
Mm-hmm.
All right, thank you.
That's right. And the key thought is if I have to pay for shipping to buy the product, then the cost of the product to me includes the cost of shipping. Now, that's sort of, it might be an interesting thought, but that's consistent with the accounting that we've always done. So we would call that a perpetual system. In the periodic system, the credit to cash is the same. Instead of debiting the word inventory, we're debiting a word or a general ledger account called freight in. Well, what is freight in? It's actually inventory. It's an asset account. Okay, it's not an expense in the periodic system. It's another way of saying inventory, but basically it's the increase in inventory because you're paying for the shipping. Likewise, let's say we look at what we've bought and we say, you know, $20 of what we bought is worthless. It's garbage. I'm going to return it and I'm going to tell the vendor, I'm not going to pay for this. Okay, that's a return. You reduce the inventory by what you are returning. And if the vendor says, okay, no problem, don't pay for it. It's okay, don't pay for it. You reduce your payable by 20. Under the periodic system, the debit or the reduction in the payable looks the same as the debit in the perpetual system. It's just that the credit of 20 under the periodic system does not say inventory. It says purchase that you are returning. Well, what is it that you're returning? Inventory. So this really is a credit to the asset called inventory under what the textbook author is referring to as a periodic system. He's just using a different name for inventory. Okay, down to discounts. And this is another one of these logic, wait a minute, what is it that we actually paid for? So we bought in total at this point $600 worth of inventory. $620 originally, but we gave back 20 of it. So we still owe the vendor 600. The vendor might call us and say, you know, you owe me 600. Yes. Gonna pay me next week? That's when you agreed to pay me? Yes. The vendor may say to you, hey, here's an idea. I need cash right now. Pay me the 600 right now. Take $12 off. Only pay me $588. Okay. What's really happening here? Now, the textbook author shows what is happening in one journal entry or one transaction. I would show this as two, because the first thing that's happening is the vendor is saying to you, take $12 off. It's, I know you agreed to pay me 600, but really just pay me 588 if you can pay me quickly. And so first, there's an agreement that you're going to pay $12 less. Then there's the actual payment that goes from you to the vendor. And so this is how I would phrase this journal entry. I would phrase it as two different journal entries, but if you think of these two things that I'm about to say together, you get what you see here. The first thing I would do is say, let's decrease the payable by 12 because I'm going to pay $12 less, and decrease the value of the inventory by 12. In fact, first, let's do exactly what we did up here in returns. See, up here in returns, we said, okay, I'm going to pay you $20 less than originally agreed, so I'm going to reduce the payable and reduce the value of the asset. Same thing here. I'm going to pay you another $12 less than what we originally agreed. And so I would, first of two journal entries, reduce the payable by 12, reduce inventory by 12. Then, second journal entry, I'm paying off the 588. I would then reduce or debit payable by 588 and reduce cash by 588. Let me say that again. I would write this as two separate journal entries, although I acknowledge if you combine the two, you get this journal entry. First, I would record the agreement to give me a discount by debiting payable, crediting inventory 12. Then I would actually record the payment by debiting payable and crediting cash for 588. Okay, let me stop now and ask any questions about that.
Can you repeat that last part?
Sure. I would have two journal entries. I'll do both. I would have two journal entries recording the agreement to give me the discount, debit payable, credit inventory 12. Then to record my payment of the discounted price, debit payable, credit cash 588. What's really happening here, and the way that I'm thinking through this, and actually it's also similar to the way that I described the 5 journal entries that we were quizzed on. It's not, it shouldn't even be necessary in a way to memorize, because there's a purpose to the way that the accounting itself is structured. And once you understand the purpose, then the accounting itself tends to fall into place. And unfortunately, the textbook author sometimes takes shortcuts or uses words as he does in the right column here, which he calls periodic system, that isn't very transparent. But usually, what the textbook author does, sort of in total overall, is indeed correct. The way that I think about this discount journal entry is what's really going on here? There are two things. I'm agreeing to pay $12 less, and then I pay the full amount that I owe. First journal entry, debit payable credit inventory, 12. Second journal entry, debit payable credit cash, 588. And once again, if you look at what the textbook author calls the periodic system, it's the same as the perpetual system. He's just using a different word for inventory. He's using the phrase purchase discounts. Well, what is it that you purchased that is being discounted? Inventory. Okay. So, sales. What the textbook author calls the perpetual system on the left is what we've learned. You're going to take $550 of inventory that cost you $550 to either manufacture or purchase, and you're going to sell it for $830, thus making a profit. What's really happening here? Two different things. The customer is agreeing to pay you $830, increase an asset receivable by $830, that increases the value of the company, that is revenue. The customer, of course, says, there's one other thing that I am doing. I'm walking away with $550 of your inventory, right? Reduce inventory, which is an asset, by $550. Well, if you're reducing an asset, then you're reducing the value of the company, and you have an expense of $550. That would be cost of goods sold expense. Now, I know you can look at what is happening on the right, and I know you can say, that looks different than what I see on the left, but it's the same. It's just really awkwardly calculated. So what the textbook author is doing is this. Textbook author is saying, okay, first of all, when it comes to the first journal entry, I'm not changing any of the words. It's exactly the same. As for the second journal entry, what I need to do in the right column is exactly what I did in the left column. I am going to debit cost of goods sold expense by $550 and credit inventory by $550. That's exactly what's happening here. See, here is the debit to cost of goods sold expense for $550. These last 6 lines all add up to a credit to inventory of $550. It's just that in the earlier journal entries, he kept using different words for inventory. And so if he had just used the word inventory, as we did in the left column, as opposed to all these different words and labels, then there would be a credit to inventory here of $550, simple journal entry. But because he was using all these different words and terms in place of inventory to figure out what is happening to inventory overall, you can't just credit inventory. He's trying to credit all of the accounts that really are inventory. How much of this do I think is quiz worthy? Number one, I would like you to see and to understand the left column. And I do want you to understand, as we discussed, that freight or shipping costs is part of the cost of acquiring the asset. Also, when you reduce the amount of money that you owe the vendor, whether because it's bad product that you bought and you're returning the product, or because you're getting an early payment discount, you're reducing the liability and you're reducing the value of what you bought. And furthermore, when you actually pay the discounted price, you're eliminating the liability and eliminating cash. Finally, when you sell the product, you're not doing one thing, you're doing two things. You're allowing the customer to walk away with the asset. Reduce inventory asset that you have sold, debit expense. And the customer is promising to pay you money. Increase receivable, which is an asset, increase revenue. On the left, this is the classic approach. On the right, basically, we're doing exactly the same thing as what we do on the left. And I have to give the textbook author credit for laying it out in this way. For each thing that happens, for each transaction, you can look at the left, you can look at the right, and you can say the only thing that is changing is he has all these little special inventory accounts instead of just using one big inventory account. Well, okay, so if you're going to put inventory costs in all these little supplemental inventory accounts, instead of just using one big inventory account, when it comes time to debit expense and credit inventory, you can't just credit the one big inventory account. You have to basically wipe out all of the little inventory accounts that you've been using. I will not ask you to calculate these numbers on a quiz. They're too rough around the edges. And actually, if I look at some of these numbers like 588, I won't actually ask you to calculate that number either. But I do want you to see why the perpetual system is essentially accounting, and why the periodic system is essentially the same as the perpetual system. It's just that instead of using one big inventory account for all debits and credits that affect inventory, you have all these little supplemental inventory accounts. And thus, when it comes time to recording this final entry, you can't just work with the one big inventory account. You have to work with or eliminate all the small ones too. Don't worry about the numbers. I won't quiz you on that. But I do want you to see why the journal entry is structured and why this journal entry that I'm circling with my cursor is actually the same as this second one in sales. Shafai, go right ahead.
How did we get the beginning and ending inventory?
Okay, so what's actually happening is, and I'm just curious whether he defines it. Sometimes the textbook author doesn't even define it in a previous, and that's what happens here. Okay, so let me give you a conceptual explanation, but let me also say that what I'm about to explain will not be on the quiz. So what happens is, let's say you go out and you say, you know, I'm going to count the inventory that I have on hand. And I just want to see that the inventory that I actually have in my warehouse is equal to the inventory that I should have according to my books. Okay. Now, let's say at the beginning of the year, I go out and I count the inventory and I'm short by $120 worth of inventory. Oh no. What does that mean? Well, that means that your books are overstating your asset by $120. Well, why? What could have happened to the inventory? Well, it could be that someone made an error to begin with in the original accounting. But it could also mean that someone who works for you stole $120 worth of inventory. Now, either way, if $120 of inventory that is currently on your books is just not there, it's gone, then you do have to credit inventory, reduce inventory by 120 because the inventory count that you counted at the beginning of the year turned it up as missing. I would simply credit inventory by 120 and not include the word beginning. Sorry about that. Not include the word beginning. But what the textbook author likes to do is not simply rely on a general word like inventory. He likes to use words and phrases that explain why inventory is going up or down. Okay. I wish I can give you a less awkward explanation, but the problem is the less awkward approach is the perpetual approach. It is the left column. It is to say it's less awkward to just use one general ledger account called inventory and use that word inventory to describe everything that's happening in the account. The textbook author is just making things a little bit awkward, but ultimately that is an inventory balance, a reduction to inventory of 120. Okay, Shafai, was that helpful?
Yes.
Okay, great.
But we just have to know the journal entries, not the values, correct?
So the values on in the left column, I mean, I'm not going to ask you to multiply something by 2%, but generally speaking, I could ask you to, let's say, compute what this inventory number is, because I believe it's 620 plus 16 minus 20 minus 12. So there will be some computation that I might ask you, but it's at the perpetual system level, which is simpler and more straightforward. I won't ask you to compute anything in the periodic system column. But I do want you to understand, number one, that the periodic system column fundamentally is the same accounting as the perpetual system. And number two, I do want you to understand that the words or the phrases that define inventory are different in the right column. Okay, Shafai, go right ahead.
If we still do 620 plus 16 minus 20 minus 12, that's still going to be 604, not 550.
So what's actually happening here is there are other things that are happening that are, other assumptions that you're making, which are buried within the givens. And so what you see here, and guys, I know, you're going through the textbook and you're thinking, okay, everything should tie, but what the textbook author does is sometimes say, okay, assume that over the course of the year, this is what's implied. Assume over the course of the year, there are other things that are happening that affect inventory. But by the end of the year, the reduction in inventory, which represents the cost of what you're selling, is 550. And so if you had the entire general ledger, right, all of it, the increases and decreases of inventory value for what you are purchasing would actually add up to 550. Shafai, do you see what I mean?
Yes.
Okay. Okay, Shafai. Oh, okay. Yeah, I was gonna say you raised your hand again, but then you put it down. Okay, well, it's 25 minutes after the hour. Let me go back here. We didn't get a chance to go into 8-7. That's okay. When we come back on Tuesday next week, we will cover 8-2, 8-3, and not everything in 8-6 per se, but basically the points that we discussed. That will be on the next quiz. We will then proceed on Tuesday to review the remaining points here. And by the way, the most important of the remaining points are 8-7. It's not part B, it's the remainder of part A. We'll then not meet on Thursday next week. And so the quiz, mostly on illustration 8-7, will be on Tuesday the following week, 12 days from today. I will go ahead and save this document with the new yellow highlights and upload it to Canvas as a reminder of what will be on the next quiz. And with that, let me do this. Let me say, class is over. Let's call it a day. You're welcome to log off. But as always, I will hang out a bit and answer questions from individual students, and everyone is welcome to listen if you wish. But no need to do that officially. Class is over. Have a good weekend, everybody, and I'll see you on Tuesday next week.
You as well, Professor. Thank you.
You too. You too. Okay, guys. Alex, go right ahead.
I had a quick question. So the specific illustrations that will be on the next test are 8-2, 8-3, and 8-6, correct?
Yes, however, and actually the last comment or interaction that I had with Shafai is why I didn't simply highlight all of 8-6. I'm not going to ask you to do all of the purchases here. And there are other assumptions like this 550, which aren't fully explained. I won't ask you to back into them. What I do want you to do, again, is to know the perpetual system numbers. And without going into the periodic system numbers, I'd like you to know conceptually why the periodic system varies or is different than the perpetual system. So 8-2 in its entirety, 8-3 in its entirety. Well, okay, hold on. I should not have highlighted periodic. Hold on. Let me simply say partial coverage on quiz, and let me yellow highlight that. I think that would be more accurate.
Okay, thank you.
Sure. Okay, other questions? Imran, go right ahead.
So just so for perpetual, it always uses inventory as a name, but for periodic, it just uses different inventory names. Is that correct?
Right, and you know how we have, so sometimes we'll have like a primary receivable account, but then we'll have a contra receivable account. And
Yes, sir.
to know what the value of receivables are in total, you have to add up the two numbers in the two accounts to come up with total value of receivables.
Mhm.
It's the same thing here. Right after the $16 in freight is booked, if you ask the perpetual guy, well, how much is your inventory worth? the perpetual guy will look at one account called inventory and in that moment say 636. If you ask the periodic system accountant, how much is your inventory worth in total? He's going to say, okay, well, the original cost of purchasing it, I put into an inventory account called 620. The extra cost of the shipment, which is part of the cost of purchasing it, is an extra inventory account called freight in. That's an extra 16. So the total cost of the asset is in the periodic system. It's just more awkward. It's not in a single account called inventory. It's split up between these two separate accounts, and you have to add them together to get your cost of inventory.
Yeah, makes sense. And does that freight in journal entry always going to be cash, or can it also be accounts payable, like on the first one?
Indeed. If you tell UPS, I don't have the cash right now, but give me a bill and I'll send it to you in the near future, then you're right. You would credit accounts payable.
Awesome. One last question, sorry.
Sure. No problem.
I know you explained to Shafe the inventory on the 550. I just kind of like got lost when you were trying to calculate the inventory for the 550.
Yeah. So what happens is there's all kinds of things that are happening to this company's accounts over the course of the year.
Yes, sir.
And that the textbook author is not claiming that every single inventory transaction is listed here.
Mhm.
As a result, when you say, okay, I'm selling a certain amount of inventory and the cost of that inventory that I am selling is 550.
Mhm.
Well, in theory, the reason why the 550 ended up in your inventory asset account to begin with is because there were different things that happened to the asset account. And so in theory, you should be able to say, okay, this thing that I'm selling, I originally bought it for this. Up, but then the value of what I'm selling went up by an amount because of freight. Ups, then the value of what I am now selling went down because I returned some of the stuff, or maybe it went down because I got a discount, et cetera, et cetera. And so you should be able to, if we were seeing the entire general ledger system, we should be able to look at everything that happened to that inventory and compute all the debits and credits related to what we are selling, and it should add up to 550. And it doesn't because there are other things that the textbook author simply assumes happened that he is not showing you. Now, if you say, well, then how can we possibly know that the value of the inventory that we're selling is 550? It's because he tells you right here to simply assume it.
So the cost of inventory is always going to be what we credit whenever we're doing so we do COGS, whatever COGS is, we always we credit the inventory system, right? Yeah.
That's right. Because whenever you sell anything, there are actually two different things happening.
Mhm.
One is the client or the customer is walking away with whatever he bought. And so you're reducing inventory by the value of what he bought. That would be an expense because a reduction in an asset reduces the value of the company.
Mhm.
That expense is called COGS expense, as you put it, cost of goods sold expense.
Awesome. Thank you so much.
The other thing that happens is hopefully the customer is paying you something for it, and so you have the receivable too.
Sure. Thank you.
Sure, my pleasure, my pleasure. Any other questions? Okay, going once.